You start off by mentioning sort of in the book the court, castle, and moat approach to investing. Can you elaborate on this technique a little bit more?
Yeah, sure. So this is a technique actually I made, and I made it because I realised consultants, every other kind of field, you've got a fairly good structure and methodology for looking at things that you can consistently apply. And fund management, in a way, misses out that. So I've pinched a few things from others on this, but the general idea is that you want to find a business with an attractive court. So that means that find management that are capable, accountable, and well aligned. And those two last ones, accountable and well aligned, are almost as important as capable when considering management and making sure that you've got management that really are vested in creating shareholder value. The second one is the castle, and that's kind of finding businesses that have a good future, that you can expect to thrive in the future, have attractive returns on investment, etc. And I kind of fleshed that out a bit in that section. And then the last one, that moat, I pinched this from Warren Buffett, of course. He loves to talk about economic moats. But I thought it was absolutely kind of a brilliant analogy, because there's plenty of businesses with good management and kind of very profitable. And yet, if they're kind of trading businesses and there's no reason that you can be confident that will carry on into the future, that business is not going to have a very high value. So it is a kind of critical part, and I kind of detail out the different types of moats that you can have. So, for example, the network effects that you might get from Google, for instance, the kind of scale advantages that they have every time you use Google. They're improving their algorithm, that's improving the user experience, and subsequently you're likely to use it more.